All right, all right, all right. Let's get moving here on our next session, Finding a Stock and Making a Trade. I'm Dave Whitmore. It's part of our trading education team here at E-Trade. And you've got me for the next 45 minutes or so, where I'm going to go through the process of turning to the stock market. Up until now, almost everything we've talked about has been in terms of diversified investing, using mutual funds, learning about the differences and the similarities between mutual funds and exchange-traded funds. But now we're turning to the stock market. Now, I'm fairly confident that for many of you, your first transaction with a company like E-Trade was probably you buying a stock that you had heard about. Someone told you about it. You had heard it was maybe hot, and you simply bought a stock that way. And I'm willing to bet further that many of you don't really understand the company, don't have a great grasp of why it rose or fell. And so that's what, from here on out, is what your investing journey is about. It's about learning about the markets if you want to be engaged this way. Let me make this clear. For many investors, they can stop from where we are right now, because all they want to be is diversified. They don't want to be logging into the stock market and following stocks. But just as many of you are intrigued by the stock market and are attracted to it because it is a very compelling way to manage your investment dollars. So with that as backdrop, I need to first, of course, display our disclosure slide. And I'll speak to the fact that I'm not making any recommendations here. I'm not suggesting any specific strategy, but there are actual stocks being used as examples in here, and just know that that's exactly what they are. So let's start. I've got a five-parter. First, I'm going to talk about why do they go up and down anyway. Then I'm going to jump into the website. We'll spend a little time using a stock screen, and I'll work through why I'm using the screen in these ways. And then we're going to talk about actually making a trade. We'll understand how our markets operate, dig into quotes, order types, and we'll make a trade. So first off, what is a stock? So a stock, as you may have heard, comes about through what's called an initial public offering. IPO is that term. So an IPO, an initial public offering, occurs when a company who is not public, they're private, owned by maybe by private equity investors, maybe by a family, who knows, but it's owned by private entity, and they want to raise capital. One way to do that is by selling shares in their company. So to do this, they go and use an investment bank. Sometimes the investment bank approaches the company and says, hey, we would like you to go public. Sometimes the company wants to go public, and they go and start vetting investment banks. It can work in either direction. But the investment bank makes the stock, so to speak. They pour through the company's finances, decide what's a logical price that they can sell this for. They go through all the legal work of creating the documents and the ownership documents and all of that, and then they market that to investors. IPO investors, and these are usually institutional level investors. Most IPOs are consumed by the institutional markets. Some is made available in platforms from companies like E-Trade, but more often than not, they are institutionally sold. Now these investors say, okay, hey, I like that. I want to buy 10,000 shares. They don't know what they're going to get, and they don't know exactly what price, because the stock's going to be priced on the day it opens for trading. And at that point, the people that put their orders in find out how much they got and what they paid for it. When they pay for it, that money then flows over through the investment bank. They get a little bit, their fee, and then on to the company. Only after all of that does the stock begin trading where we can buy it on the open market. And by the way, that little sidebar there, sometimes when an IPO is greatly anticipated, it's in the news, investors know they want to get shares of it. And if you're a new investor, maybe you don't even know that those periods existed in the past, because it doesn't seem like it now. But that's called a hot issue. And when that's the case, probably the first trade on the open market is very often much higher than whatever the IPO price was. That's just one of the issues with that. Okay, so that's how a stock comes to be. And after that, it begins trading in the open market. So now the question, why do they go up or down? So there's an old adage that says stocks go up when there are more buyers than sellers. Now, technically that's incorrect, sort of, because every stock trade has both a buyer and a seller. Someone's buying it from someone who is selling. When you buy a stock, you're not buying it from E-Trade. You're buying it from another investor. So technically that's not right, since every trade is one buyer and one seller. But the difference is that it's the motivation of either the buyers or the sellers. If the buyers, people interested in buying this stock, are highly motivated, it will push the stock up because they will buy from whatever shares are being offered and then buy more from whatever shares are being offered, and the stock will rise. But here's a fun little quote. Benjamin Graham, famous for his finance book, widely just simply called Graham and Dodd. It was a college-level finance book for decades. But this book, The Intelligent Investor, is one written for us. And it's a good book. It's worth reading. It's old, written in the 1940s, but it's the basis of, say, Warren Buffett's approach to investing comes from Ben Graham's thinking. But here's his quote. In the short run, the stock market is a voting machine. But in the long run, it's a weighing machine. Now, okay, neither of those things seem to have anything to do with finance. So what's going on here? What is Graham saying? So let's first talk about the weighing machine. What he's saying there is that in the long run, and what's the long run? Let's just say over a number of years. Let's just think very long run. A stock will rise or fall depending upon how much money it's making. And that's something that can be measured specifically. It can be weighed. You can put it on a scale and know exactly what the number is. And as that number rises, as the profits that the business has made from period to period to period rises and rises and rises, the stock value will rise. If the money that's being made by this company over the very long run falls and then falls and then falls and then falls, the stock value will fall and fall and fall and fall. That's over the very long run. But in the short run, there's something very different going on in the stock market. It is investors, traders, sometimes with very different time horizons, buying and selling shares, often reacting to news and events and catalysts, and effectively voting for what they hope will be the outcome. I'm buying that stock. I'm voting for it going higher. So this is what expresses the short-term gyrations in the stock market, the voting reactions of investors and traders emotionally reacting to things. But over the very long run, the stock market and the value of a company will be correlated to its ability to generate profits for its owners. And so that turns us to something where at this point, I am going to be nudging you off to where you need to learn more, because these two subjects that I want to talk about here are worthy of their own sessions alone. But let's talk about it. When we talk about stock research, about ways to try to understand this company, this stock, there are two basic schools of thought. One is called fundamental analysis, and the other is called technical analysis. Now, the irony here is that the one that sounds simple, fundamental analysis, is actually much more complicated, I believe, than the one that sounds difficult, technical analysis. Technical analysis is a very visual activity. Fundamental analysis is a very financial activity. But let's compare and contrast the two. So first, fundamental analysis. So fundamental analysis looks at things like how much money is the company taking in their sales. How many iPhones are we selling, and are we expected to sell more of those? And what's the price of these iPhones? That's the revenue the company has. From that comes their profit. We call that earnings per share. Earnings per share is a simple idea. It's just the profit of the company after they've taken taxes out and expenses and everything, divided by how many number of shares exist. Also, important part of looking at a company's profitability, its earnings, is whether those are expected to grow. because future growth is a huge assumption and driver of stock values. If the market collectively believes that a company is not going to be growing its earnings, that stock will generally not be very favored and is likely to be sort of a dog. Stocks that are expected to produce strong earnings growth for a number of years, those are the popular stocks that folks are trading and are generally very high priced. Another important thing is to at least be aware enough of the industry, and within the industry, the sector of a stock that you have, because the conditions in an industry, and even more broadly, the sector is just a collection of industries. So, for instance, the energy sector consists of oil drillers, oil refiners, oil transporters. So understanding that those drivers really do drive a lot of the performance of a stock that you'll own. Valuation is another thing that we talk about when we talk about the fundamentals of a company. Valuation, well, one simple valuation is the price per share. That's the price of the stock per share. That's a ratio. But the other valuation ratios that we use here, we compare the price of the stock not to share, but to its earnings. And now we can see, how does the price of the stock compare to the earnings and the growth of the expected earnings? And this is a big process that fundamental analysts go through. So to put it in a nutshell, we say fundamental analysis is looking at the company. And I think you can see most of these things all talk about the business that the company is in. And as I said, this is a topic that I spend a full session on. So I did that in one called Stock Investing 102. You'll find that at etrade.com/events. Can I have everybody raise their hand right now and say they will go watch that webinar? All right, good. That was unanimous. Thank you. All right, technical analysis. Technical analysis doesn't care one bit about iPhones or earnings per share. Technical analysis simply concerns itself with the chart. It's just analyzing price. So some of the terms and approaches that we use in technical analysis is we try to figure out what's the prevailing trend in this stock. Is it going up or going down? We use various techniques to figure out where what we call support might exist. That's an area where we would expect the stock to bounce if it moves down to that area, or resistance. That's an area where we would expect the stock to turn back if it rises up to that price point. There are techniques for figuring out where support or resistance might live. We also use a variety of ways to figure out the momentum of the trend that is going. Is the stock moving rapidly and strongly or slowly and sedately? Well, there are methods in technical analysis that let us see that. So we say technical analysis is just looking at the stock, not the company. Now, it's an artificial distinction, of course. They're part of the same thing. But I just think it's helpful to realize that when we're looking at technical analysis, we are just focusing on what is happening in price. If we want to personally include an analysis or an assessment of the fundamentals of the company, we can do that. Same thing, if we're focusing on the fundamentals as our way to invest in stocks, we can then turn to technical analysis to see how that jives with what we might think about the business of the company. And this is a point for our second pledge. I would like you to go to etrade.com/events and seek out and watch Stock Investing 103 using stock charts. So now we have to start thinking about, what are you looking for? Why? What makes sense for you? And to me, that question starts off with, well, what kind of investor are you? But then I'm saying, or do you want to be? Because some of you might not know what kind of investor you are, because maybe you're not one yet fully. So think about this as, what do you think you want to do with this brokerage account? So on one end extreme is what I'll simply call the diversified investor. And this is what we have been speaking about most of the morning today. A diversified investor who uses ETFs and mutual funds and creates a portfolio that's allocated across a diverse set of asset classes, including stocks and bonds and some foreign stocks and some domestic stocks. And this kind of an investor generally doesn't transact very often. The only time transactions usually are occurring is when we're adding money to the portfolio or when we're rebalancing the portfolio, maybe moving some of the portfolio from stocks into bonds if, say, for instance, stocks have performed strongly for a while. So this is not somebody who's probably going looking for stock ideas. There are other long-term investors who are very focused on stocks. Over the years, all of us have seen many clients over the years with large, diversified stock portfolios, maybe holding 60 or 70 stocks, many of which have been held for a very long time, and they're paying dividends. Other people who are focused long-term stock investors sometimes are very focused in their portfolio, and they make big investments in a certain area of expertise or a certain bet on an industry. There certainly are investors like that. I doubt any of those are in this session. And if you are, we have more detailed information for you. You can find that at etrade.com/events. For most of you, if you're a newer and younger investor, maybe this is something aspirational, if you will, if that's the kind of a long-term investor you might want to be. Now, this requires focusing on fundamentals. You have to, you're making decisions based upon the future forecast because you're holding stocks for years. You really have to have a sense of the future of this company's business. So that's my second archetype here, if you will. Now, as we move on our spectrum, we're moving more toward the trader approach. And so one term that is sometimes used here is what's called a swing trader. So a swing trader buys stocks, but isn't holding them for years. A swing trader is holding them for a few days or a couple of weeks or a few weeks, maybe a couple months. But a swing trader is trying to capture those swings in a stock chart that we see. Everybody's seen a stock chart. They go jigga, digga, jigga, jigga, they go zigzag, 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 zigzag. And a swing trader is trying to trade those zigs and those zags. The technical analysis is a huge part of this. Fundamentals are important because one thing you certainly want to know as a swing trader is you sort of want to have a sense of the quality of the company that you're using as a trade. If it's a money loser, if your idea is based upon some industry, then why not find a better company that's in the same industry? But my point is that swing trading is moving more down the line of active, shorter-term trading, and that culminates in the day trader. Day trader is doing this sort of the same thing as a swing trader is, trying to capture those swings. He or she is just trying to capture smaller parts of the swing. Here, price analysis is basically all you have. Very little fundamental changes in the middle of a trading day, especially if you're only holding a stock for a few minutes. And yeah, there are day traders that hold stocks for just a few minutes, hopefully capturing just a few cents per share, but they're generally doing it with leverage and using relatively larger amounts of money. I'm not advocating this. I'm just telling you that this exists out there. Other day traders hold for maybe most of a day. But one important thing about day trading, it's a term, it's a label that gets totally misused out there. Day trading is very specific. Day trading means you bought and you sold that thing on the same day. If you hold it overnight, it's not a day trade, no matter how short-term you might want to think about it. We certainly hear in the financial media that financial media seems to refer to anybody like you who has an online brokerage account as a day trader. Well, that's not true. You don't have to be. Know this, day trading is very risky, and it has additional requirements that you can run into. We don't need to discuss that in detail here, but there are additional equity requirements to pursue a day trading account. So this is important for you because this now helps inform how you go about looking for your investment ideas. And so what I want to do is sort of lay a little groundwork about how you can think about picking stocks. So first, I want you to ask 4 questions about the fundamentals of the company. does the company sell? How big is the stock? Is it expensive or cheap? And does it pay a dividend? What the company sells is important. It's what I talked about in the beginning. The industry or the sector. Technology, food, oil, knees. These are all different markets and all different drivers of their profitability and all different reasons to own them. Company size is important. We call this market capitalization, and it's very important for you to pay attention to. We'll talk about it in a moment when I jump into the website. Is the stock expensive or cheap? This is that value question. We'll talk about that in a moment. And does it pay a dividend? If you're a short-term trader, you probably don't care. If you're going to hold a stock for 10 days, you probably don't care. If you're a long-term investor, you should care because dividend are an important part of long-term returns for stocks. And then two aspects that are part of the technicals. The first one is the stock going up or down? Now, this is the question of trend. And we go into that in great detail in that 103 session that I referred to you earlier. And then the question of risk is a question about volatility, and that is something that you want to be aware of. There are ways to see how volatile that stock has been and can be expected to be, and it's certainly something you should take note of. So I want to now share my monitor and jump into the website and show you where our stock screener is, and then just run a few sample screens before I come back to finish up. All right, so let me go back to the complete view page. I was a little deeper into the website there. So this is the complete view. This is where you land when you first log in. And where we're going to go is to our stock screener. And we're going to find that up here in markets and ideas. And then I go down to stocks. And when I land on that page, I'll leave you to explore here. We're going to go to our stock screener. But one thing that you might consider is this little publication here. This is from a research company called Argus. They write objective stock research, and we have their research here. And this is what they sort of call their focus list. I think it's about 50 stocks, but it's basically a list of stocks in various industries that they essentially like. And they give you information on those stocks. And so it's a list of stocks from which you might consider shopping. That's the only reason I bring that. But let's go to the screener. So the interaction on the screener is simple. I just click a tile, and it begins to sort out the 10,309 stocks that are in the platform. So you can see I clicked mega cap here. This is just the largest of the large cap. So if I use large cap and mega cap, we see that there are 828 stocks that are of this large cap size. So what does that mean? Remember, market cap is just the price of the stock times the number of shares. So it's the total market value of the company. Of 10,000, only 800 stocks here are large enough. And the criteria here is $10 billion or greater. So what's interesting about this little exercise here is I just want to show you how this universe distributes. How many mid-cap stocks are there? So out of 10,000, there are about 1,100. Mid-cap, that's lower than 10 billion, down to about 2 billion. Small cap stocks are 2 billion down to, say, 300 million. And there are almost 2,000 stocks in that group. And then finally are micro-cap stocks, which are less than $300 million. This is the world of most penny stocks are in this category. You will find stocks in this category that aren't pennies, but they just don't usually trade very often. So at any rate, you can see how that distributes. And by the way, if you added up each of those numbers, you'll see that it doesn't total to 10,309 because there are a couple thousand, I think, whose values are less than $1 million, and they're eliminated from the screen that I just used. So look, large cap, small cap are important considerations, and I just want to put it this way. Large cap stocks are going to be easier for you to research. You're going to find more objective research in our website. They're also going to be more widely followed, institutionally held. And finally, if you are inclined toward options at all, the large cap stocks are where the action is in options markets. If you're in the beginning, you don't need to concern yourself with that. If you're more of an intermediate, just know that if you want to have options as an available strategy element, focusing on large cap stocks is appropriate. As you get down into small cap and micro cap, there's going to be less and less research. You're going to know less and less about these companies. You know, in the world of mega cap stocks, my guess is that, let's take a look at the results, you're going to know most of them. Probably won't know all of them, but, you know, these are names that we all see. If I brought up a screen of small cap stocks, chances are we would know none of them. So that's one reason to care, and that really is a reason to focus, to at least know whether you're seeking out stocks. Focusing on large cap stocks is important. If someone is telling you about a stock and you find out that it's a micro cap or a small cap stock, realize you're stepping into an arena that is quite opaque and difficult to verify and research. So I want to run a couple here. So one, as I mentioned before, and let's keep large cap. One focus is to start with an industry. You know, maybe you've decided that technology is something that you're interested in. So you can see here, I've said large cap, and then under the technology sector, there are 170 stocks that match that. And then there are sub-industries. So, for instance, if I go down to financial technology, fintech, well, there are 3 of those stocks. I'm kind of curious. Let's see what they are. So Coinbase, that's crypto involved. Fidelity National Information Service, that's a back office financial business. And then Intuit, obviously tax software. Not exactly cutting edge of the fintech world, but at any rate, if you're inclined to be thinking that way, you can navigate through, go to each particular sector, and then you'll see what we have inside it. The software and IT services is one of the bigger groups here. This is where we're going to see a lot of companies that you know. The whole growth and value idea is a little bit, let me put it this way, it's a little bit artful in how to think about this. Let me clear all and go down into this area and talk about these screening elements. You'll see here earnings and dividends. So we've talked about earnings per share growth, right? I've talked about how important growth is. So let's go for really fast growing companies. So I want to see stocks that their earnings growth is growing at an annual rate of 25% or more, measured on the current fiscal year and next fiscal year. So that's based upon an estimate of what their earnings are going to be next year. And so what you can see is I've taken that 828 stocks down to 32 stocks. Let's say we also want revenue growth to be 25% or more a year. Now I have 10 stocks. Let's see what they are. So one of the things that happens here is some of these, you know, Tesla, certainly you know about Zoom Info. Maybe that's not Zoom, by the way. But maybe Datadog, EQT, Mercado Libre, you know, maybe you haven't heard of these. But this is an interesting jumping off point where now I've got this small list of stocks that are expected to grow strongly. And now I can start to learn about them if I wish. And I can do that in a couple of ways. One is to simply hover over the symbol, and that'll give you a 3-month chart. The most important of which I think is the lower part. That's showing you how, in this case, Tesla has performed compared to the S&P 500. You can see here in the last month, it's been underperforming it. That's it'll take to the snapshot page for that stock in the website where you can further explore it. And about the group of their community. It's also a good step if you have a stock idea, seeing who their competitors are, stock in a way, very valuable step. One of the twists on that is, let me do a little variation on that screen where what I'm going to do is sometimes called GARP, or growth at a reasonable price. There's that valuation notion. So what I'm going to do is I'm going to say, all right, I'll take 15% annual growth and just 10% revenue growth. So I've expanded my list. I've got more stocks now. But then I'm going to come up here to what we call the PE ratio. And this is one of those valuation ratios that we use. And it's a simple notion. It's the price of the stock divided by its earnings per share. And so it gives us a way to see what we call the multiple. How much is the market paying for the earnings for that company? Now, the question is, what's a high PE? What's a low PE? Well, think of it this way. The PE of the overall market, the S&P 500, is generally ranges between sort of the low teens up to 20 or a little higher than 20. 15, 16, that's sort of the general PE of the S&P 500 index collectively. So, a little higher than that is expensive. A little lower than that is cheap. But what I'm saying is I'll pay a little more, but I want to get a decent PE for the kinds of earnings growth that I'm getting here. And I'm going to have that measured on what's called a trailing 12 months basis. So that's just using the last 4 quarterly earnings amounts and next year. And I've done is narrowed my screen to 0 because there aren't any stocks that match all of that. Probably what happens if I move my revenue and earnings requirements down. Okay, so now I have 8 stocks. And so this is a different approach now. I'm saying I want growth, but I also want to get it at a reasonable PE ratio. I'm using that as what we call the valuation. One more thing, and I'm going to simply describe a couple ways you can use this, and we'll jump back into the presentation. But another way to sort of narrow down this massive universe is to come down here and use the opinions of some of the research providers that we have available. Number one of which I want to point out is Morgan Stanley, our parent company. One of the most respected investment houses, investment banks in history. Producer of fantastic research. They rate stocks using a scale of underweight, equal weight, and overweight. The basic idea here is that overweight means, hey, we like it. You should own more of it than whatever index it's in. Equal weight means, we're okay with it. If you own it, you should just own the same amount that it represents in, say, the S&P 500 or whatever index. And then underweight means, well, if you hold it, don't hold too much of it. So basically, bullish, neutral, and bearish. And the other one that is useful here is Argus Analyst, where this is like the Morgan Stanley reports. These are analysts or a team of analysts who are following the company and expressing their opinions about that company. The important value in these research reports is it really gives you in-depth into the narrative of the company, what's been going on with it, what are the themes that have been driving it. So using those ratings let's clear all our criteria and let's see what happens if we just use some of these. So let's say we want stocks that Argus rates a buy and that Morgan Stanley rates overweight. Okay, so there's 117 in the whole universe. Let's go to large cap. All right, so we eliminated 6. Now I want to throw one more on there, and that's research from this outfit here called Market Edge. Market Edge's research is purely technical, so it's all about the price chart. The Argus report and the Morgan Stanley report are going to focus more on the fundamentals of that company. So now I want to say, all right, I want market edge to view it as long, meaning bullish. And we have 15 stocks now out of our 800 that qualify for that. One helpful thing here that I like to do is to sort on the industry column so I can see them grouped. And we can see there are some pharmaceuticals at the bottom. We have a lot of energy representation, not surprising given the way energy stocks have been performing along with crude oil. So this was a tour through the screener to sort of try to reinforce those notions about fundamentals and technicals that we talked about at the top. So now I'm going to stop sharing, and we'll come back to our slides, and let's talk about markets and trades. So markets generally are just where money and goods change hands, a place where people that want to buy stuff and people that want to sell stuff come together. But they take different forms. And the stock market is a market, but it's not exactly like these other three forms. So here I'm just showing three examples. A grocery store. Grocery store, you walk in, you can buy the entire shelf of stuff if you wish. The price doesn't change. It's on the board. Here's how much apples are. They're $3.99 a pound. Okay, fine. Once the apples are all gone, the apples are all gone. In farm markets, we might be buying or selling apples too, but it's very different. In farm markets, there might be more than one person selling apples, and they might be similarly adjacent in their stands. So in this sense, the sellers here are in effect competing with each other. One seller might say, oh, you're selling your apples for $3.99 a pound? Okay, we're $3.49 a pound. And so people come over to buy the apple at $3.49 a pound instead of $3.99. But then the $3.99 goes, well, mine are $3.39. In this way, sellers can compete with each other, especially when they are in a market situation where they're adjacent to each other. Now, what's interesting about that is, let's say one farmer sells apples out. Well, then now the guy that's the only one left can roll the apples back to $3.99. So at any rate, two places where you could buy apples, but have a mechanism of how price changes. And that's the important point here. And now consider an auction. An art auction is where two buyers are competing with each other. So there's one painting. Paddle number one says, I'll pay $100,000. Paddle number two says, I'll pay $110,000. No, I want it at $120,000, $130,000, and until prices in the painting is sold. So what about the stock market? Well, the stock market competing with each other to execute their trades. Okay? Who are these people that are doing it? Well, investors. The first is us. And by us, I mean you and I, individual investors. Yes, I work in this business, but I don't invest professionally. I just simply invest my own money. I don't invest institutionally or anything like that. So individual investors. But remember, it's a mistake to think of individual investors as sort of this monolithic group. There are long-term stockholders and there are short-term traders. There are even shorter-term day traders, which we've talked about. And some individual investors have vast sums of money, and some are small. On the other side, our mutual managers are able. Mutual fund manager has money that comes into the fund. It makes stocks.
Hey, Dave. I'm sorry to interrupt you. I think you got a little bit of a digital hiccup there. We, of course, are all in various locations. I'm on the West Coast. Dave is on the East Coast. So not sure if you have a battery going out in your Bluetooth headset or we're just having a little bit of an internet glitch, but people are saying you're breaking up, but we're not losing much at this point in time. But can you test your audio for me, please?
What would you like me to do?
Okay, yeah, I think you're there. I'll step in if you drop, but so far you're good. Just a little bit pixelated, digitized, internet glitches. So.
Well, I don't think it's not refreshing my browser. I'm just on my phone.
Okay.
I mean, I don't really have a solution.
Thanks.
Okay.
Let's keep
let me
going
continue.
forward.
So the other side are professional investors. And when I was talking about other portfolio managers, they would be, say, like running a university endowment or a pension fund. And then there are all these more tactical short-term trading desks, at a company like a Goldman Sachs or a Morgan Stanley, where they're trading in the markets. But the bottom line there, market makers and dealers, is something that we need to understand, because in a lot of the markets that we trade in, a market maker or a dealer may be on the other side of the trade. So let's talk about that. So when you are looking at stocks, you're going to find that they trade in a number of venues. So let's compare and contrast. So the major U.S. stock exchanges are the New York Stock Exchange and the NASDAQ stock market. Stocks that trade here have to meet minimum listing standards, and they must also continue to file properly audited financial reports, income statements, balance sheets, etc. And then these stocks that trade here, many of which also gives you, the investor, a wide range of choice in the types of orders you can use to execute a stock trade. We'll talk a little bit about that coming up, but file that away. Now, on the other side of my ledger here are the over-the-counter markets. So terms for this sometimes are OTC. You may have heard in the past terms like pink sheets or bulletin board. This is the world of penny stocks and others. Not all OTC stocks are penny stocks, but most penny stocks trade in these over-the-counter markets. So here's the rub with stocks in these markets. One, there are few or no standards for listing. Some of these markets have a listing standard, but these do not rise to the level of what the NYSE or the NASDAQ requires. Second of all, there is virtually no automation in these markets. And what that means is there's only one type of order you can use to transact in an over-the-counter stock, and that's a limit order. And we'll talk about that coming up. If you're drawn to penny stocks and you want to place an order in these OTC stocks, you're going to be presented with this document that is going to make sure that you understand the potential treachery that can exist in these markets. I've underlined the 7 or 8 different points that are made here. Certainly encourage you to read them. All right, so now let's turn to the trade, and it starts with a quote. So a stock quote has two sides, the bid and the ask. The most important thing for a new investor is to realize that even though you're looking at a screen and it shows you a image of a bid and ask, it can be changing continuously. Some stocks changing more rapidly and quickly, others change very slowly, but realizing this is not a static number. It moves. Even though on your screen it might look like it's there. So one way to take a look at a quote is to appreciate the difference between the bid and the ask. So the bid is the price at which someone is trying to buy the stock right now. I want to buy at $43.65. The ask is the price at which someone is willing to sell. I will sell at $43.70. That difference is what we call the spread. And it's important for you to observe it. Let me just give you to express the significance of what it can be. So the spread is just the difference, so it's 5 cents here. We take that and divide it by the cost to buy it, which is the ask, $43.70, and that gives you 0.0011, which is 0.11%. Okay, so that's 5 cent spread on a $43 stock. Here's Coca-Cola. Coca-Cola trades on the New York Stock Exchange. Take a look at the quote. 1 penny difference between the bid and the ask. It's a $52 stock. And by the way, the number that is next to it is what's called the size. That's just the number of shares wanting to buy at $52.63 and the number of shares wanting to sell at $52.64. So that spread cost is a fraction of the one we just looked at. This is 1 penny on a $52 stock. That's good. Here we have a NASDAQ stock that has a considerably wider spread between the bid and the ask. In fact, it's 45 cents a share on a $32 stock, which is almost 1.5%. And then lastly, I dug up a penny stock to show the extreme size of the spread. Here we've got a stock that has a 16% difference between the bid and the ask. Were you to buy at effectively 30 cents, and it stayed unchanged for days, and you decided to sell, you would get 25 cents having paid 30 cents, and you would lose that 5 cents a share. So spread cost, very important. Pay attention to it. It really is an important step in making a trade. And here's my last example. If you encounter an OTC stock that has no bid or ask displayed, it is because this stock has become restricted by our regulators. And when this is the case, we cannot display a bid or an ask. We cannot accept opening orders. The only thing you can do is sell. This can come out of the condition. It's usually because they're deficient in filing something. They can come out of it and become trickle again. But if you encounter this, that's the reason. All right, last step, make a trade. I'm going to use Coca-Cola. We give you a bunch of ways to place a stock order. You'll notice that there's a buy and a sell button in the upper right. You also can see that our quotes are links. So you can click 5264 to start a buy order or click 5263 to start a sell order. And then our trading menu up above, if you navigate in and want to go directly to, say, a stock trade, you can navigate directly that way. Once I click the ask, I'm going to assume I clicked the ask because I want to buy. So it brings over the symbol. There's the symbol for Coca-Cola, and buy is already chosen. If I made a mistake, I can switch that to sell just by clicking that little drop down. I then have to choose the number of shares. I'll use 100 in my example. And now we come to order type. So you'll notice it defaults to what we call a limit order. There are several orders in here. I want you to focus just on market orders and limit orders. Let's compare and contrast. So a market order is executed at the best available price when your order reaches the trading destination. If you're buying, it's probably going to be done at or near the ask. Notice my hedging language there, probably done at or near. That's because prices are moving. But our system is fast, and it'll reach that destination in less than a second. So the amount of change is probably not magnitude. If you're selling, they're probably going to be done at or near the bid. So the benefit of using a market order is that once you send that order, you're going to be an owner of the stock. What you don't know, which is your risk, is exactly at what price. A limit order lets us control that part of it. So with a limit order, you specify the price. And for a buy order, it's the highest price you're willing to pay. If it's higher than that when your order reaches its destination, it will not be executed. When you choose to use a limit order, you also have to say how long it's going to be good for. Time in force, we call that. So the last point here is if you're trading those OTC stocks, this is the only kind of an order you can use. So the benefit of a limit order is that you're now controlling the price of the trade. It's the minimum you'll take on a sell. It's the maximum you'll pay on a buy. But the risk is that you might miss the trade. You might be trying to nibble below the market, and then it starts moving away from you, and you might never end up buying it if you are sticking to a limit. So those are the two order types. There's no perfect answer. You have a good benefit and a negative on the other side. It's a personal choice that you'll need to make. So here we are at our order ticket. Notice it's giving me my estimated cost, certainly something you want to pay attention to make sure that you didn't do something incorrect. That's 100 shares at $52.64 for $5,200. We still haven't sent our order. We do get a chance to preview it. So this is, in the old days when you were speaking to a broker, the broker would make sure he repeated back to you exactly what you wanted to do. Okay, Mrs. Jones, we're going to buy 100 shares of Coca-Cola at a limit price of $52.64, and that order is good for the day. Is that correct? Yes, that's correct. Let's place that order. So, a little takeaway. I know I've gone a little over. We do have another session coming up in 10 minutes. If my guys want to throw me some questions, we'll see what we can do. I do apologize for whatever audio came up. But look, fundamental and technical analysis are useful approaches that you should become acquainted with. I really, really urge you to go in and look at those 2 sessions, Stock Investing 102 and 103. When you're making a trade, be a little bit deliberate about it. Look closely at the quote conditions. Think about the market that it's trading in. Maybe be a little leery of low liquidity stocks, and learn about the various order types that you can use. And with that, I am ready to leave you for the final session this afternoon, Forks in the Road, a survey of alternative investments. Rick Swope is going to sort of now talk to us about, okay, well, there are some other things out there. What are they? And includes a discussion about things like real estate investment trusts and other things. I don't know exactly what Rick has planned. Guys, we have 9 minutes till the next one. Do you want to throw me any questions? Anything I should cover?
I'm going to throw you one. Well, first of all, Dave, it's quite amazing that we can execute something like this. The audio is simply the internet. You're in Jersey, I'm in California, Rick's in Georgia, Steve's in Chicago, Brittany. So it's incredible that we can do this. So audio things, it's the internet. But Victoria had a question that it's a simple question, but it's an important one. How to search for a specific stock. So let's say there's a company I've heard about and I'm interested and I might want to invest. How can I find out if it is even something I can invest in, publicly traded, in other words?
Well, good one. I probably should have covered that, so I appreciate that. So in the website, let me do a quick share. So in the website, if it doesn't come up in time, in the upper right, there's a little search magnifier. If you want to quote on a stock, just put the symbol in there. It'll take you to there. If you don't know the symbol, then type the name in there, and it will come up with the choices. So let's say I'm looking for something called Pepsi. So I just start writing PepsiCo, and now you'll see it's found PepsiCo. It shows me that the ticker symbol for Pepsi is PEP. And as long as I know symbols, that's the quickest way. But if you don't, you just type it in the search box. Easy as that. I got a question from Julie. It's about tax implications. Look, swing trading and intraday trading, they're taxable trades. You make a profit, they're taxable. They're always going to be short term, and so they are what they are. There's no shielding that. So I think
then Dave, finally, let's go ahead and wrap. The number one question coming up is, where can I review these sessions in recordings, and where can I find more information? So close with that.
You got it. So a couple things. First of all, a copy of my slide deck is available in the resources widget. It's the green widget below the screen right below. Furthermore, you can go 2 places, etrade.com/events, where all of our webinars are recorded and available and searchable on demand. That's where you're going to go find 102 and 103. And then we have a special URL set up for this event. That's etrade.com/workshop, where you will find the information as well. With that, I'm going to move on. Appreciate, again, all the hardy types that have kept it up all day. We greatly admire you. And by the way, I'll just remind you, again, these are all recorded. I know we assume a lot of people probably went through the first couple and will come back, but you can always do that. Great. Thanks a lot. Sean, thanks for helping out at the back end. Good luck out there, and talk to you in the next session, folks. Bye now.